What happens if you have the following two spot rates? A 1-year spot rate at 2% and a 2-year spot rate at 3%. Which is better? That's hard to answer because they don't have the same time horizon, so let's equalize the 2 years. Now, which one is better? The big question is, what is the rate after 1 year when reckoned at time zero given these two spot rates? Since it's a rate that's not happening starting at time zero, but at some forward or future date, it's clearly not a spot rate. For now, let's call it a forward rate for simplicity to distinguish it from spot rates. Now let's go back to the question, what is that forward rate then, in order for us to answer that question? Okay, so in this video, we'll try to answer that and we'll talk about the concept of a forward rate and how to make sense of it in preparation for future videos on interest rate derivatives where we will have more in-depth discussions. It will be seen that while there are varied ways actual interest rate derivatives will work in the market versus what we're going to be discussing in this intro discussion, they still all basically conform to the same idea, that of agreeing today to perform something in the future to replicate a desired financial outcome. So, what should be the forward rate F? Let's use an indifference argument as follows. We should be indifferent as to whether we invest for 1 year at 2%, then roll over another year at F versus locking in for 2 years at 3%. Now, why should this argument work conceptually? Well, because if not, then there will be arbitrage opportunities where one will fund using one source and invest in the alternative, or vice versa. We did that kind of argument in our previous video on bootstrapping, and it's a recurring theme in derivatives pricing. Because the market is expected to eventually trade out any mispricings, then any practitioner will end up being indifferent to one or the other or any other alternatives. At least that's the argument. Given this, then the indifference argument will give us the following equation of value. Therefore, the forward rate should be 4.01% by this argument. Please note, however, that this 4% number is merely an expectation by argument. We cannot expect that this 4% will magically surface a year from now without doing anything extra, because if we simply do nothing, then we are open to reinvestment risk in a year's time, and there is no assurance that the actual 1-year rate at that point will be 4.01%. In fact, if the liquidity preference theory holds, then what's to stop the expectation that if now markets prefer 2% for a 1-year rate and 3% for a 2-year rate, why would the 1-year rate in a year's time be suddenly 4% instead of still 2%? Does that mean the 2-year rate is way higher than 4% for the liquidity preference theory to still hold by then? So as you can see, these are all speculative, unless of course, there's a party you can transact with today so that you can agree now at time zero that borrowing or lending can be done at 4.01% in a year's time. Well, if you can do that, then indeed you can be indifferent to the two legs or approaches. In this case, the contract is a forward contract rather than a spot contract. And in this case, it's a financial derivative. We shall postpone formally talking about financial derivatives for now, as we wish to focus instead on the basic concepts first and not clutter this video with so many details that can confuse our viewers if we start talking about actual instruments in the market. It'll just suffice to say that what we need here is a financial derivative, in this case, a forward contract to achieve the desired equivalence. And as such, contract law defines the relationship between the two parties. However, if there is an exchange similar to, a stock market where contracts are exchanged, then the forward becomes known instead as a futures contract traded in a futures exchange. Regardless, for now, we shall simply call them a forward rate to simplify discussion so that we can revert to our previous thread on the indifference argument we were pursuing. Now suppose that markets can actually transact at the forward rate F. Now what happens if F is not equal to 4.01%? Let's consider two scenarios, F at 3% and F at 5%. F at 3%. Here one can see that the accumulation with a rollover is lower than if you had locked in for 2 years. This means option A is cheaper to borrow from than option B. So you fund from A, then invest in B. So you can borrow 1,000, for example, discounted at 1.0506 and get 951.8. Turn around and invest only 942.6. That will pay 1,000 in 2 years' time that you owe to A. You get an arbitrage profit of 951.8 minus 942.6. What if F is 5%? Here we see that the accumulation when locked in is lower, indicating that B is the cheaper funding source. So you borrow from B, then invest in A. In this case, borrowing from the lock-in rate gives you 942.6. So you turn around and invest 933.7 in A. The difference between the two being your arbitrage profit. At maturity, you receive 1,000 from A, which you use to pay B, and that closes this transaction. Given this, therefore, the market is expected to price out all pricing anomalies, giving a no arbitrage forward rate of, voila, 4.01%, where the markets become indifferent between A and B. So, there you are. That's one way to think about the forward rate. The important thing is not the expectation, but that you can actually transact at that forward rate and that there's a market for it where you can transact it efficiently. Okay, so time for real life. In reality, you don't directly contract with counterparty A or B or anything like that. What happens is that you contract with an exchange or with a financial intermediary such as a bank who will deal with other parties and make markets to get the kind of scale needed to make this work. Therefore, the illustration provided a while ago gives one a conceptual idea of how things work and is only an approximation of what actually goes on in reality. For example, there might be a no arbitrage range rather than a single no arbitrage rate. Or, there might be no actual exchange of principal amounts. Only the differences in cash flows are exchanged that pretty much simulate an underlying transaction of borrowing or lending at the forward rate, as if principal amounts were actually borrowed or lent, etc. But don't worry, we'll eventually get to these topics. But for now, it will suffice to say that there is a vibrant interest rate derivatives markets out there where all these wonderful contracts can be used to financially engineer a desired outcome that simulate the discussion we just had above. Anyway, these discussions will be reserved for future episodes. Meantime, that's all we have for now. Kindly like, subscribe, or write a comment below to help support this channel. See you next time!